I'm just curious, from your standpoint as a venture capital investor and dealing with other investors who are trying to allocate capital in this space. How do you think about the overall macro picture? Because when I think about the macro picture, what's the Fed going to do with rates over the next 6 months? Will there be a crash this year? Things like that. That sort of goes against what I think about in private equity or specifically venture capital, because venture capital, my money is locked up for 7 years, 10 years. So do I really care about the macro picture over the next 6 or 12 months when my money is locked up for 8 to 10 years? How do you think about those two things?
It's a great question, and it's an interesting one. In principle, the idea being that if you have this long-term view, this long-term commitment to venture capital as an asset class, these, fluctuations in, the 1, 2, 3 year time frame have less impact. In practice, though, I hear a lot of chatter with other managers that have a broader, we'll say, venture capital mandate than we do. They're very much down focused on the Bitcoin stack exclusively. And they have a lot of trepidation, even for large institutions that feel like, okay, just take a pause. They feel more comfortable with a pause. So even though that you should have that kind of disinterested, hey, the conventional wisdom, buy when there's blood in the streets, a time like this year is necessarily a great time to at least go out and see where how people are feeling about pricing, and maybe actually get to have a little bit more ownership at the fund level for some of these investments. I do know that there are managers out there that have said that their LPs have just felt a little overwhelmed by trying to process everything full stop. So in practice, sometimes it doesn't meet the academically agreed on standard as far as like this long-term view. For us, I think one of the ways that you, Mark, and TVP are very strongly aligned is we see some fundamental flaws with the structure of the system, and we know that in the end things are going to be fundamentally different. We think that sound money is one of the key components, and we think that market view wise, Bitcoin has already won the battle for the internet in the internet age, the base monetary layer, and so we're preparing for that kind of long-term view. And one of the ways that we were actually sort of managing against what we would see as a certain type of risk, where some of our investors might have trepidation, they might be feeling the pain of public markets and what they might be seeing at this macro level, is by kind of really dialing in with family offices and individual investors that we might have very different opinions on a wide variety of subjects, but around this one unifying idea of Bitcoin being the internet age's monetary standard, we're aligned on that. And so investing in these companies that help realize this transformation to a new sound monetary order, we wanted to grow purposefully. And so we've attracted like a great group of investors around us that are at least aligned on that sort of principle. That's not to say that we're not subject to some of the stresses of looking at the macro picture, though.
So then, it's something that you're certainly paying attention to, but it's not really something that's driving your decisions, would you say?
Definitely not. I think as far on the decision driving question, I think this year has been an interesting year for bear market and bear market year fallout reasons, I would say. But in a broader sense, it's important for us to we can't be tone deaf to what's happening in public markets and in the broader alternative asset landscape, because as we grow as a firm, net new investors for us will come from the institutional base. So we have to be keenly aware for the challenges they're facing and what their market impacts what impacts are happening to them and their portfolio overall.
Yeah. Some of the problems have really come because of socioeconomic paradigms, I think, that we live in today, such as just short-term thinking. And so you have this bigger institutional involvement today, but institutions are constantly being judged by their investors on a mark-to-market basis. And so, I know other fund managers and other markets, public markets, and in order to make the big returns, they need time. But their investors are judging them on a monthly basis. And then they're like, how can I make these big moves to get these big returns when you're constantly comparing my returns on a monthly basis? And so it starts to cause these types of problems. And I think about, Warren Buffett, his partner, Charlie Munger, says the big money's not made in the buying and the selling. It's made in the waiting. So one, waiting for the right opportunity, but also two, waiting for that opportunity to actually take time to develop. Warren Buffett has this thing he called 20 punches or whatever. If any new investor would come in knowing they had 20 moves, 20 punches, their whole career, they'd outperform. And that's because they're not over trading. And Warren Buffett said, I don't buy stocks. I buy companies. They just happen to be publicly traded. And what I think he means by that, or what I take from that, is he buys a company. So I'm going to buy, he likes capital efficient businesses like a Hershey or Coca-Cola. Do you think people still buy soda in the future? Yes or no? Great. Well, then Coke should be a good long-term investment. Tesla. Do you think people will buy more EV vehicles in the future or less? Great. Then I should buy Tesla and sit up for the long term. Or do I think for Bitcoin, do I think governments will print more money in the future or less? Will governments take more of our freedoms or give us more freedoms back in the future, right? And so, but that's that long-term view, right? And I think if people would approach it like that, everything would change. It would go back to the Warren Buffett, 20 punch kind of mandate. How do you think about investors and allocating towards venture capital? From best practices or from what you've seen, should it only be done by people that are super rich? Should it only be done with a tiny, minuscule piece of portfolio if you love gambling? Or how do you think about that for most people?
For most people, the average person, I would say venture capital's not necessarily a fit for them.
Well, when you say most people, I would imagine you probably break that down by portfolio size. So if you have a 5-figure portfolio or even a 6-figure portfolio, maybe not, but once you get over 7, maybe it's something you consider. Or how do you say for most people? Is that based off portfolio size or just for mentality?
Yeah, I mean, from a regulatory perspective, it's one of these closed to average folks kind of thing. So you've got to be at least accredited, if not a qualified purchaser, to participate. That's a whole wormhole we can discuss at some point on the regulatory questions there and fairness of it, but that is the regime that as it stands. And so for people that they're a potential investor, they're considering it, you have to think about all sorts of questions. Is it a sector play? Is it, like you were describing, is it electric vehicles, for example, or space exploration, or you have a view on a thesis of Bitcoin or some life sciences, an explosion in life sciences. So then you've got to go from that thesis and then try to identify and get access to the best managers available.